This program is brought to you by realestate.com.au. Keep moving with Australia's #1 address in property.
Welcome back. Casino operator The Star resumed trading on the stock market on Friday after being suspended for nearly a month. Its new chief executive, Steve McCann, is focused on cutting costs and liquidity. One of its lenders is Patts, the ASX-listed investment company. During the recent financial year, Patts reported a 32% increase in revenue to about $832 million. Its net asset value increased to almost $12 billion, and it increased the final dividend to 55 cents per share. I caught up with Patts CEO Todd Barlow on Thursday, and we discussed the results and the success of its private credit business, which includes lending to companies like The Star.
Well, I think that the results are very good. The cash that we generated across the portfolio was up over 10%. So that shows that our profit doesn't always give a good indication of the performance of the business. So we saw profit down a little bit on the back of poorer result from Brickworks because they had impairments in their property assets, and New Hope was coming off significantly higher coal prices. But New Hope still produced their third highest profit on record, so it's still going very well. Coal prices are still very high, just not as high as they were. But the cash generation across the portfolio is excellent, and that's enabled us to pay the higher dividends again for the 24th year running.
Well, you mentioned Brickworks. Obviously, construction sector's had a tough year. It posted a net loss, but it's not often you see a devaluation in properties used for logistics. We've obviously seen that in the office market, but not commercial logistics. What's happened there over the last 12 months?
Well, industrial property is still the best asset class in property. It's demanded by supplies, logistics centres who need to be in well-located areas to meet the online consumption demand. The rents are going up. The only thing that's changed is that the interest rates have gone up. So, of course, you see an expansion in cap rates, and that was the thing that impacted the property prices last year. So the quality is still there, the demand is still there, the pricing of rents is going through the roof, but we saw a slight expansion in the cap rate.
Do you think the outlook for construction is improving?
I think construction is challenging for a variety of reasons. Construction costs are still very high. The availability of labour is very high. The regulatory environment is challenging. So, despite us having a crisis in terms of the house prices and undersupply of new housing stock for to meet the demand from new immigrants, I think construction is very difficult. And manufacturing in Australia is just generally difficult, particularly with higher energy prices.
We've heard from the Labor government this week potentially thinking about making changes again to negative gearing, and they say it could improve the housing supply. Do you think if negative gearing is removed, will it fix the housing supply problem?
Well, as I said, there's a lot of things that go into the housing crisis that we have, and the fact that house prices are too high and there's an undersupply. The lack of skills, the regulatory environment, the costs of construction inputs, all of these things are contributing to the problems that we have.
Look, you mentioned New Hope. Obviously, coal prices have come off. That's really why it hasn't been as good as previous years, but they're in the running to buy Anglo American's mines in Queensland. Do you think they've got a good chance of getting that deal over the line?
Well, I think they look at a lot of things, and clearly, some of those assets are far too big for New Hope. I think they're more focused on their own mine development. They're going from about 7 million tonnes of production last year to about 14 million tonnes of annual production in 3 or 4 years. So they're growing organically. I think that's their focus. And coal prices are still historically high at about $140 a tonne. So with that extra development and mine output, they'll generate very good cash.
Now, I know you're also an investor in The Star. This morning, as we record this on Thursday, they've announced they've received a $200 million new funding deal to keep operating. Have you been working closely with The Star over the past couple of months?
Our credit team has. So we are a provider of credit to The Star. We're part of the syndicate. The syndicate has extended some extra cash to help them through their short-term difficulties. We've been working constructively, and it's really good to see that there's a positive outcome.
Yeah, obviously the future for the Star, now that they can keep going, could be pretty good. They've obviously got that great asset in Queensland that's only just opened.
Yeah, I think really what happened with the Star was they just had a short-term liquidity crisis in the sense that they had cost overruns with their major asset in Queensland, and they needed to fund that shortfall. And now that they've done that, I think they're on their way.
Your private equity business did well. You've got the likes of Ironbark, Amp Control, some swim schools, but you've really stepped up the investment in agriculture in the past 12 months. What's really driven that?
We bought one major asset, which is a packing and processing facility down in Shepparton. That's going to be good for our existing assets because you get that sort of vertical integration, and we can control the chain from farm gate to the sale and export of these high quality products that we have.
Emerging companies portfolio did well. Just take us inside the management team. I mean, how often are you doing due diligence on emerging companies and meeting with entrepreneurs?
Well, we've got teams of people who look after each portfolio, and they're constantly meeting people. They're very active portfolios. That emerging companies portfolio has evolved over the years. It started out doing some sort of pre-IPO financing, and then as the IPO market started slowing, it moved into looking at more growth companies and some sort of textile growth companies. Then we saw that market coming off, and then it moved into some sort of growth commodity businesses. Last year it deployed $200 million into uranium assets because we believe very strongly in the outlook for energy. So it really is a very actively managed portfolio by a team of people who are constantly seeing great opportunities.
Credit portfolio has also picked up. You've called that out in your results. Is that because banks are now getting a bit more hesitant to lend money, so they're turning elsewhere?
I think that's part of it. Certainly if banks were able to lend to the people that we're seeing, they wouldn't be talking to us because the bank would be a lot cheaper than us. But what we provide is a bespoke solution for people who are needing some capital in some format, and we have the flexibility to be able to design something that fits their needs. And as a result, we get a very good instrument in the sense that it's downside protected. It sits above equity in the capital stack. It's generating above equity returns, but as I say, it's downside protected.
Yeah, I think that credit portfolio has really lifted, particularly in the last 12 months. I mean, what's the outlook there going ahead? Well,
the growth may not be replicated because we doubled in size in the last 12 months. We added about $500 million to that portfolio. It's up to about $1.1 billion now. It's generating over 14% annual returns. That's not easy to find that stuff, and it will certainly we'll get as much as we can get, but the market for is limited for that product.
And just explain the success of Milton Corporation since you completely bought it out in 2021. What's that helped you do?
It's been enormously helpful for our business and really transformative. And so in the presentation today we're going to talk about how it's performed over the last 3 years. And against our key objectives, it's done everything. So from a risk perspective, we think we've de-risked the business by moving into more uncorrelated, diverse asset classes. So that's going to make the business more resilient. From a cash flow perspective, we've generated 20% growth per annum over 3 years in our cash generation across the portfolio. So that's enabled us to pay dividends at 15.3% growth per annum for 3 years. So that's really significant. And I mean, to put that in perspective, the market growth in dividends over the last 3 years has been 0.9%. So we're generating a lot more cash out of the portfolio. And then if you look at the net asset value growth and the capital growth of the portfolio, it's grown at 13.5% per annum. That's almost double what the market has done. So if you think about that in dollar terms, we've added about $2 billion of capital to our shareholders on top of market growth over the last 3 years. How do you rate the strength of Australia's economy right now with where things are sitting? I think we're pretty good. I mean, Australia's always been a good place to invest. We've got some challenges on the horizon. Everybody does. I think that demographically we're in pretty good shape. We've still got good export markets, good products to export. There's no doubt we've got our challenges, but we have a portfolio that has international exposure, but we are predominantly focused on Australia. and I think that that's something that won't change.
Todd Barlow, Chief Executive of Patts, thanks for your time.
Thank you very much.